Gold has performed quite well in the last few days, buoyed by some softer Fed speak and also a little bit of risk aversion. The move into safe havens, especially at the start of the week on the back of what's happening in Israel, was quite clear. But I do think there is a broader picture as well in terms of what the Fed is saying that's having a more influential impact on the sustainable basis for the yellow metal. And what I mean by that is we have seen a surge in US bond yields over the course of the last month or so on the back of some very hawkish Fed speak. There's been a lot of talk about interest rates being higher for longer, really reaffirming that message, but also the prospect for another interest rate hike from the central bank as well, which is something that the markets had not really positioned for. They weren't really buying that message up until that point. And now that the markets have started to increasingly buy into that Fed message, bond yields have been spiking. It seems to have alerted the attention of the Federal Reserve since the last meeting, to the extent that many officials now are even referencing those higher bond yields as potentially meaning that they don't need to raise interest rates any further because bond markets are already tightening. Now, that seems quite an unlikely message for me personally, because if we do see interest rate expectations are just lower, then that would bring bond yields obviously lower along with it. So it's interesting to get that message from the Federal Reserve. But ultimately, what we have seen is bond yields adjusting lower, as you'd expect in response to those messages, which has enabled gold to rebound higher. Of course, gold in itself did fall quite considerably on the back of all of that very, very hawkish Fed speak. And of course, this week, we've got plenty of US information, data, minutes to follow. And that's going to be the key focal point. Already today, we've had the PPI figures, which were hotter than expected. But also this evening, ahead of following this recording, we've got the Fed minutes, which largely are outdated at this point, given the amount of commentary and the changing contrast of the commentary that we've had from the Fed since that meeting. But then tomorrow we've got the US CPI inflation data. That's now huge, especially on the back of that PPI release. And on that basis, let's take a look at a gold chart. So here is the sell-off that we saw in gold over the period when we were seeing much higher US bond yields on the back of that very hawkish Fed speak. And here is the move we've seen in the last 3 or 4 days on the back of much softer Fed speak, and also that move into safe havens when we were seeing some risk aversion at the start of the week. Now, from a technical standpoint, there's a few things which stand out which are really interesting. One is that we saw support around $1,800. Now, you can see $1,780 to $1,800 has previously, over a long period of time, been a very key level of support and resistance in gold, and it's proven to be the case again. Yes, it front ran it slightly. It was around 1810 that we actually ultimately rebounded off, but I think that was aided by the jobs report last Friday and that risk aversion and softer Fed speak at the start of this week too. So I think there was fundamental factors which prompted a faster rebound on this occasion, perhaps more so than just technical levels coming into play. The other thing that's interesting now is these fib levels, because we've got the highs here from the 20th of September down to the lows here on the 9th of October. Now, those fib levels interestingly fall around levels that have historically actually been quite interesting areas of support and resistance for gold. So you can see it's 1862, 1878, and 1895. So roughly speaking, we're talking 1860, 1880, and 1900, levels which we've previously seen gold respond to support and resistance. Now, what's interesting also is that 61.8 fib falls around the upper part of the descending trend line as well. So you've got a confluence potentially of indicators coming into play there, and we're also not too far from those moving average bands as well. So if we can overcome all of those, then that would be a very, very bullish signal for a variety of reasons. So it's going to be a massive test for gold if we do see sustained more dovish Fed speak or more neutral Fed speak, which enables gold to move back above that, say, 1900 zone. Then all of a sudden, that's a lot of technical resistance, which we could potentially see being taken out here, providing that bullish signal potentially for the yellow metal. But at this point in time, it remains bearish because we are below the descending trend line. We're below the moving averages. We are in a corrective pattern at this point in time, and therefore this is still a relatively bearish setup, but it is going to be interesting to see how the momentum indicators continue to perform on approach, given that we are already trading in this zone of Fibonacci. And that also coincides, as we've highlighted previously, with these areas of support that we saw during the declines back in the summer. So the fact that those fib levels coincide with those mean that, again, a break above here is a strong technical signal. Now, when I say the way the momentum indicator are going to perform, I mean on the lower time frame. So for example, we look at the 4-hour time frame here, already we're starting to see signs of divergences. We're seeing high highs still on the stochastic. We're still seeing slightly higher highs on the MACD moving averages as well, but that histogram is already showing early signs of potential divergence. On the lower time frames, those divergences will become clearer earlier than what we see on the higher time frames, especially as we're talking about counter trend moves as well. So that's another thing that we have to bear in mind when we're talking about divergences forming. This is a counter trend move, so looking down at the lower time frames will provide a much clearer uptrend for the recent moves that we are seeing in gold. But it is ultimately going to be fundamentally driven, I think, because of what is to come. Ultimately, while the recent moves in gold have been driven by a softer tone from the Federal Reserve, what's going to be critical going forward ahead of that meeting at the start of next month is going to be the ongoing Fed speak and whether they commit to that softer tone, but also the economic data, which we get from the US, starting with the CPI inflation data tomorrow, but then plenty more to come going into the end of the month.